Hi, this is the Wells Group. I am Dominion Madilanyane, and this is...
My name is Horata Echampong, and on this presentation, we'll be talking about fraud within the accounting profession.
Accountants safeguard financial integrity, but face fraud risks. This presentation urges the CIMA ECO's conceptual framework grounded in ethical theories like the agency theory as a proactive tool against dilemmas it will explore. Threats like self-interest, self-review, and familiarity via real scenarios. Then propose theory-anchored mitigation strategies to build a resilient ethical identity beyond mere compliance. Moving on, we'll be discussing the theoretical justification of the CIMA Code of Ethics. First, we'll look at the agency theory. The tension between principals and agents, where the agent uses information to prioritize personal advantage over accurate record keeping. Moving on, we have the virtue ethics. Is on individuals' character rather than specific behaviors. Then we have the deontological ethics, the duty to be honest, holds that obeying a system of norms is morally correct regardless of their repercussions. And finally, we have the Unitarianism theoretical justification, which says that morality is determined only by the deed itself.
Common threats to the accounting profession. Firstly, we'll be looking at the self-review threat. This is when professionals evaluate their own work, neutrality is compromised, and fraud is made possible. This is known as the self-review threat in finance. A scenario is where a senior accountant who designed a new inventory valuation system is later assigned to audit it. Part of their work, they unconsciously overlook a critical flaw that overstates assets. Consequently, the company reports inflated profits, misleading investors until an external reviewer discovers the error. The second common threat in the accounting profession is the self-interest threat. This is when personal benefit clashes with professional obligation. The self-interest threat emerges, progressively undermining objectivity. Accountants may be persuaded to justify aggressive behavior by bonuses, job security, or reputation. The second threat we're going to review is the self-interest threat. This is when personal benefit clashes with professional obligation. The self-interest threat emerges, progressively undermining objectivity, which is one of the fundamental principles of the CIMA Codes of Ethics. Accountants may be persuaded to justify aggressive behavior by bonuses, job reputation, or job security. A scenario is when an auditor discovers a material error that will significantly reduce a client's reported profit. However, the client threatens to terminate the audit firm, costing the auditor their job and bonus. Fearing personal loss, the auditor minimizes the issue, allowing misleading financial statements.
Next is the familiarity threat. The familiarity threat arises when an accountant's neutrality is compromised by personal relationships, which lowers professional skepticism. Biased decisions such as insider trading may result from it. A scenario is when a close friend serves as the CFO of a company you audit. When reviewing their expense reports, you notice questionable claims but hesitate to challenge them. Fearing it would damage your friendship, you approve the reports, compromising professional objectivity.
Now we'll be handling the mitigation and safeguards for these various threats to the accounting profession. Firstly, we'll be starting with the self-review threat. External auditors should insist on independent verification and be cautious not to rely too much on management's own assessments and reports. For the self-interest threat, it takes more than just ethical training to mitigate the self-interest threat. It requires structural protections. Essential resistance is produced by strong company governance, which includes independent directors and audit committees that are prepared to question the management. Some of the strain is relieved by transparent compensation rules that do not prioritize short-term manipulation over long-term stability. Last but not least is the familiarity threat. Safeguards for a familiarity threat focus on restoring objectivity and professional skepticism where a long or close relationship with a client exists. These include rotating senior audit partners and key engagement team members to provide a fresh perspective, arranging an independent review of the work by another partner not involved in the engagement, and limiting the length of time senior personnel serve on the same client.
Finally, the recommendations. We recommend to rotate audit partners, decouple composition for short-term results, mandate independent reviews, establish safe whistleblowing channels